Hey, Allison, can you see what I see?
Hi there. Yes, I sure can.
And can you hear me okay?
Yes, I can.
Awesome. I think we're good to go.
Awesome.
Thanks.
Hi there. Good afternoon. My name is Allison Dutcher, and I am happy to introduce Aaron Staufer. He will be presenting this fantastic Lunch and Learn webinar for you today. This is going to be recorded. We will send this recording along with the PowerPoint that Aaron is presenting with today in a follow-up email after the presentation. I'm excited to introduce Aaron. Aaron is one of our incredible sales managers at Elevations Credit Union. He's been in the mortgage industry for a number of years. He is an incredible leader, and he is a fantastic person to learn from. And this is his forte. Next to lending, teaching is one of his favorite things. So Aaron, I'll let you take it away.
Awesome. Beautiful. Thank you so much. So Allison's going to kind of aggregate questions along the way. She'll come back on screen, and when she's got a few populated, she'll go ahead and pop those in. We'll field them live. So if you have questions, please ask her. She would love nothing more to aggregate those, and I would love nothing more than to answer them. I tell people all the time, my love language is acts of service. So if you have a question, truly all you're doing is bringing me joy. So please bring it on. So yeah, thank you so much for spending your lunch with us. So a little bit about me, and it's a little bit more relevant in this presentation than some of them, because my history has a lot to do with property management, which is a topic we're going to get into a fair amount today. So I went to college. I actually got my degree in philosophy of all things, and I minored in biology, kind of my two passions at the time, philosophy and biology. And then I did that knowing that I was going to get into real estate. And much to my parents' chagrin, you don't necessarily have to have a specific degree to pursue real estate. So I did. I went to school for what brought me joy more than anything else. Graduated college in 2008 and immediately got my real estate license that same year. It took me a few months, but I got my real estate license. And that was the single worst time to get your real estate license. And it was the worst time to get your real estate license because the housing bubble was popping. All of a sudden, there was way too many homes, way too few buyers. Things were just kind of imploding. And as a rookie real estate agent, it was a tough market to get into. And the systems I was trying to work were, hey, talk to your sphere of influence and your network and try to, build your database out from them. Like my network, I just graduated college. I know like 3 people and they moved out of state. I have no network. So I started trying to do anything I could to keep the lights on. I started getting into being a showing assistant where I would just show homes for other real estate agents, open houses. I was working as an administrative assistant. I was doing, working as just a house caregiver, basically, taking care of dogs, taking care of puppy sitting, that kind of thing. And then I started going down the path of property management. So I would vet tenants. I would double check the tenants, make sure that they're in good shape as well, double checking their references, all of that. So I went from real estate into quite literally anything else I could just to keep the lights on. I survived in that environment for about a year, and then I got into lending, and I've been doing that ever since 2009. It's been a little bit of a better fit for me personally. But yeah, so when I was in real estate, I was doing anything I could to keep the lights on, including property management. So a lot of my kind of horror stories you're going to hear as we kind of go along. So yeah, that's a little bit about me. When I'm not doing mortgages or teaching other loan officers how to do this job, I love to go for motorcycle rides. I love to take my dog Finian for rides. So if you ever see an Irish setter and sidecar, that is Finn and myself. As far as he's concerned, it's his motorcycle. I just take care of it for him. So yeah, that's one of the things I did at the very beginning of the pandemic to bring joy. Some things got moved up, some things got moved back. I decided to go buy a motorcycle with sidecar, something I was planning on doing in retirement. I just moved that way up. So, all right. So like I said, my experience with rental real estate, I used to be a property manager. I used to manage my own rentals, my own self. And I do still have a few rental properties that I maintain, although I do use a property management company currently. I'll talk about the pros and cons of all of that as we kind of go along. So here's what we're going to be talking about today. We're going to define what an investment property is, okay? We're going to be talking about the difference between residential and commercial real estate, and there is a big distinction there, and the rules and guidelines differ drastically between those two. We'll be talking about some of the advantages and disadvantages. I'd say we've spent the brunt of our time on this, advantages and disadvantages of investment properties. Financing requirements, how do those differ from when you bought your first home? Differences in the types of homes, condos, townhomes, single family, duplex, triplex, fourplex. We're going to be talking about all that. We're going to start looking at your current situation. Should you convert your current home into a rental? And what do you need to be on the lookout for if that was going to be the path you decide to go? Tenant management, property management. And then finally, we're going to wrap up with some numbers, analysis and comparing different rentals. I mentioned all of that because 2 things. One, it's a lot of information we're covering. Okay, so strap in, get caffeinated, get ready to go. And 2, I mentioned all that because I also want to mention this, which is here's what we're not going to be talking about. Okay, I don't say that to get negative, but I do want to make sure that we're not going too far down the rabbit hole with any specific scenario. So number 1, how it compares to other investment strategies. I really don't see my job as trying to convince you that this is right for you. Okay, it's really my job to kind of give you the lay of land, tell you the pros and cons, give you some different directions you might pursue, but really ultimately trying to compare this to a mutual fund or an annuity or whatever. Not really my job. If you want that sales pitch, if you want to talk to somebody about that, I'd strongly recommend a wealth management advisor. They can give you the pros and cons of whether or not this is right for you. My job is really just give you the lay of land, what is and is not possible. Okay. What are your specific tax consequences? So this used to be something when we did this pre-COVID and we were doing these classes in person. I would literally have people bring to those seminars like piles of tax returns and say, well, what about my tax scenario? For that, we should take it offline. So save all my contact information. It's going to be on the last slide. Aaron Staufer, Elevations Credit Union, very easy to find. More than happy to get into your personal tax scenarios and whether or not your tax consequences of investing make sense. But probably not the right venue on a webinar in front of a whole bunch of people. So I'm not a CPA. I don't pretend to be a CPA. You'll hear me say that a couple times. Not a CPA. And then finally, why you should invest in real estate. I'm not a real estate agent either. I used to be, but I'm no longer a real estate agent. So it's really not my role either to try to convince you that you should invest in real estate. I'll tell you the pros and cons. I went the whole Warren Buffett route, which is invest in what you know. I invested in real estate. So I'll tell you the pros and cons of it, but I'm not really going to try to convince you why you specifically should invest in real estate. Talk to a real estate agent. They'd be more than happy to give you that spiel. All right, so let's start by defining what is an investment property. Okay, it seems like a kind of obvious place to start, but there's actually some very nuanced pieces of this that actually have some repercussions down the line. So ultimately, from a lender's perspective, there's three different types of properties. Okay, first one is your primary residence. That is the property where you spend your days and nights. The technical definition from a lending perspective of what a primary residence is a property that you're intending to occupy within 2 months of closing, 60 days, and you intend to live there for the next 12 months. That is the definition of a primary residence. Now, not too far-fetched to say, hey, great, live in the property within 2 months of closing, live in the property for 12 months. Well, great, can't I just buy a new primary residence every 12 months? And the answer is yes. It is a form of financial house hacking. You can buy a primary residence, live there for 12 months, convert that into a rental, go buy another primary residence. Put, again, the minimum down. If you're a first-time homebuyer, it's 3%. If you're a repeat buyer, it's 5%. You could go around and buy 3 primary residences over the course of 3 years, accumulate 2 rental properties, have your primary residence, and each time put the minimum down, which is 5%. It is a form of financial hacking, and it works really, really well until you no longer want to move, until you get sick of living that nomadic lifestyle. This was kind of how me and my wife started out. And she got me in the middle of me doing this. And then she's like, hey, can we like stop moving for a minute? So it's great so long as you don't mind the nomadic lifestyle. Eventually, you don't want to live in boxes anymore and you want to sit down some roots. But it's a great direction to go if you want to accumulate some rental properties with the least amount down rather quickly. And when you do, when you convert that primary residence into a rental, you don't have to change the financing terms. It's really, really nice. You did exactly what you said you were going to do. Live in the property within 2 months of closing, live there for the next 12 months. That's all you signed up to do. It's a really great option if you don't mind living that nomadic lifestyle. A second home. A second home is a property that you tend to live in part of the year, okay? And it has to be significantly far away from your current residence or geographically different. Okay. In Colorado, we use a little bit more common sense than a lot of other lenders would, because we know that it can be geographically different in Colorado without being significantly far away. Okay. Significantly far away, government will typically reference a 40-mile rule, like it has to be 40 miles or more away from your current house. Geographically different enough, if you live in along the Front Range and you're trying to buy a house up in the mountains, it automatically would meet that threshold. Now, other part of second home is you have to be planning on living in the property part of the year. The real idea is, hey, you want to buy a house up in the mountains, live in it, a few months of the year and then rent it out during the rest of the time. Perfectly fine, perfectly sufficient, meets that requirement, okay? But you do have to intend on living in the property part of the year, which means you can't really be signing up for a long-term lease on that property, okay? And then an investment property. An investment property is a property you purchase with the intent of renting it out. Okay, it does not have to be significantly far away. You do not have to be planning on living in the property part of the year. It just has to be a property you're buying with the intent of renting it out. So primary residence minimum down payment if you're a first-time home buyer is 3%. If you're a repeat buyer, 5%. Okay, second home minimum down payment is going to be 10%. Investment property, the minimum down payment is going to be 20%. Also, primary residences have the lowest interest rates. The government's found out, all things being equal, if times get tough, you're more likely to skip payments on a second home or an investment property, less likely to skip home payments on your primary residence. You're more likely to evict a stranger than you are to evict your spouse or yourself. Okay, so primary residences have the least amount down, lowest rates. Second home, second lowest down payment, 10% down minimum. Similar rates to an investment property. Investment properties, 20% down minimum. Now, we also have to distinguish between residential and commercial. We're going to be talking about residential today. Okay, that is my sphere of influence. That is my area of expertise. Commercial is a completely different animal. The running joke is that commercial lenders laugh at what we do and we laugh at what they do because they're just drastically different from one another. How are they different? Well, residential, it's going to cover anything between 1 and 4 units. Okay, so single family residence, single family detached, condo, townhome, duplex, triplex, fourplex, 1 to 4 units. Anything more than 4 units, 5plex or above, apartment complexes, whatever, is going to fall under commercial territory. Okay, or anything less than 1 unit, vacant land, also commercial. How is vacant land commercial? Yeah, you're not wrong. Okay, commercial is a total misnomer. It does not mean it has to be used for business purposes. It simply is a catch-all for anything that does not fit conventional guidelines. Conventional guidelines, 1 to 4 residential units. Okay. It also has to be with residential, zoned residential or mixed. Residential has to be a permitted use of that property. Okay. Commercial, yeah, business units are perfectly fine and acceptable. Okay. It does not have to be zoned residential or anything like that. They'll basically accept any zoning so long as the intended use is permitted. Okay. With residential, the appraisal is focused on the value of the property, right? They're going to look at, hey, what are properties in the area selling for? We're going to use that as a basis to calculate our value based on those comparable sales. We think the value of the property is this, okay? Commercial, they're going to try to create value of that home as well. But one of the ways they could do that is to figure out how much income that property can generate. Kind of interesting, but one way to calculate the value of a property is to figure out how much income that property can generate. So appraisals on commercial properties are typically based on focusing on how much income that property can generate, and from there calculating what that value of that property is. Kind of like calculating the value of a company, right? Well, how much income does that company generate? Yeah, we can create and calculate the value of that company based on how much income it actually generates. Same thing with commercial, okay? Residential, 30-year fixed, very common. That was actually established by Fannie Mae and Freddie Mac. These are Fannie Mae and Freddie Mac guidelines. 1 to 4 units, that is Fannie Mae and Freddie Mac definition of residential real estate, okay? Well, before Fannie Mae and Freddie Mac came along, 30-year fixed mortgages did not exist, okay? So when you're looking at commercial, that means it's the bank or credit union's own personal money. They get to decide what rates to lend it out, what terms to lend it out, all of that. Well, it's typically going to be a shorter term adjustable rate mortgage. Okay. Rates fixed for a shorter period of time and then it's adjustable, or it'll have to be re-upped. So you might have to have your income documents renewed or reviewed every couple of years to make sure that you still qualify for the loan that's currently extended. Residential, will typically require 2 years of tax returns. We'll typically close in 30 days. Commercial is a little bit of a different arena. 3 years of tax returns is very common, and they're going to have longer processing times. I mentioned all of that to say this. If the properties you're looking at buying do fall into this commercial definition, you need to talk to a commercial lender. Okay, Todd Payock, he's our VP of commercial lending. He's a wonderful guy. This is his phone number right here, so take a screenshot, write it down real fast. So I joke that lenders fall under 2 different camps. They are either indoor cats or they are outdoor cats. Okay, conventional mortgage lenders, like myself, we tend to be indoor cats. Okay, we are in front of our computer, we are working on numbers, we are working on qualification, we are attending closing, but we are rarely out of our office. We go to closing, we come back. Okay, we tend to be indoor cats. Commercial lenders tend to be outdoor cats. Okay, they tend to be out of the office. On the rare occasion that you do see them inside, oh wow, it's kind of odd to see you in a different environment. I mentioned that because if you reached out to Todd, you do not get a hold of him right away. Give it a day, call him back. Okay, you are not pestering him. He's an outdoor cat. He's out in the field. That's where he makes his living. Conversely, we're in front of our computer all the time. You call me, I'm getting right back to you. So Todd's great. He's worth the wait. But if you reach out and you don't get a call back, try again. Again, you're not pestering him. He's just not in front of his computer. All right. So why have an investment property? Well, there's really 2 different investment strategies. Okay. You could buy for appreciation, or you could buy for cash flow. Now, any property you're getting, it's probably not going to be mutually exclusive, right? It's going to have some aspects of both. That's the hope, right? And most real estate does have aspects of both. But you need to kind of think about what your primary strategy is, okay? So when you're buying for appreciation, the most comparable like investment is a growth stock. Okay, you're buying it at one price, you're buying Tesla when it first came on the market, and you're hoping it's going to increase in value. You're going to sell it when it's high, right? Bitcoin, right? Getting a growth. You're hoping to buy it low, sell it high, That's growth, right? Well, when you do that, the less emphasis is on cash flow. And that translates to stocks too. When you buy a stock that's focused on growth, there's not going to be a lot of dividends, right? They're not going to be paying you a lot of money each month. They're simply focusing on reinvesting all their money back into growing it, right? Fix and flips are a perfect example of this. And it's the most extreme example of buying for appreciation. You're buying it at one value, planning on doing some work to it, and selling it at a future value that's going to be higher. You might not receive any cash flow. You might not receive a single dollar of rental income. You might buy it 3 months later, sell it. It's entirely possible that that's the case. So fix and flips are the most extreme example of buying for appreciation. When it comes to real estate, single family homes appreciate more than townhomes, which appreciate more than condos historically, okay? You don't see a lot of fix and flips with condos or townhomes. You see most fix and flips done single family detached. It's not accidental, right? There's more meat on the bone for that investment strategy when it comes to those properties. Buying for cash flow. So in this case, you're not really planning on selling the property, right? You might not be planning on selling the property. So you don't really care about the growth or the appreciation of it as much. Your focus is primarily on having it pay you monthly income. It's like a dividend paying stock, right? You are buying a utility company where they're literally capped at how much they can increase in value, but they will pay you a recurring dividend, right? Or Apple or whatever. That's a dividend paying stock. Your goal is to receive more money on a monthly or quarterly basis than you are paying out, okay? Less emphasis is on appreciation. You might not have very much appreciation at all. The most extreme example of buying for cash flow I can come up with, one of my friends, he invested in real estate in Missouri, and he was buying a lot of what they call Section 8 housing. Section 8 housing, it's like a coupon or a voucher program through the government. It's basically subsidized housing, okay? Maybe you don't make enough money to be able to afford rent. Well, maybe you can receive Section 8 housing, and the government will help you with some of those payments. Well, with Section 8 housing, the appreciation is basically non-existent. This words coming from my friend who invested in Section 8 housing in Missouri. I was like, do those houses appreciate? He's like, oh, good grief, no. They don't appreciate like at all. But they have a very solid cash flow. My payment is only X. I'm receiving Y. The difference is my cash flow. I'm receiving more money each month than I'm paying out on a monthly basis. So very little appreciation, but very good cash flow. That's the most extreme example of that, where legally there's limits as to how much they can actually increase in value. Okay. So it's a longer term strategy. If you're going to be, banking on that cash flow, banking on receiving more than you're paying out on a monthly basis, it's going to be a longer term strategy. Some of the advantages of investing in real estate, the largest one by far and away, is leverage. Leverage, 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 leverage. You're going to hear me say it a lot. Sorry in advance. Real estate, in my opinion, is all about leverage. And yes, that's coming from somebody that is on the financing side, right? So all I do is leverage. Every day I do a loan, that's leveraging, right? So the idea behind leverage is if you're the consumer and you're trying to lift up this, expensive asset of your house, how do you afford to do so? Well, the home loan is the pulley system, right? That allows you to ultimately lift up that house and afford that house, right? Well, the good thing with real estate, investing in real estate, is if you're a first-time home buyer and you put 3% down, you get 100% of the appreciation. It's not like the lender gets 97% of the appreciation. No, that is your asset. You put down 3%, you get 100% of the appreciation, right? You put 5% down on a primary residence because it's not your first time. Yeah, you still get 100% appreciation. You put 20% down as an investment property, you get 100% of the appreciation. So not only does the home loan allow you to do what you otherwise would not be able to do unless you can pay cash for the house, right? But it allows you to leverage your assets elsewise, right? You could say, oh, great, I'm going to put, instead of buying one house cash, I'm going to go finance 5 homes, 20% down each time. I'm going to go finance 5 homes and put 20% down. Now you're getting 100% of each home appreciating in value, right? There's the financially savvy decision, and then there's the emotional decision. And the two don't always go in lockstep with one another. The financially savvy decision, and you're going to see the numbers in just a few slides where it kind of becomes pretty obvious. The financially savvy decision would be, hey, great, leverage, 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 leverage. The emotional decision is, I don't like debt. I don't like debt. I want to be debt free. I want to pay cash for homes. Perfectly fine. My job is to provide solutions, but that is unique to real estate. If you want to go buy stock, you have to put up 100% of the value. You want to go buy $100 of Apple stock, you have to put forth $100, right? You can borrow on margin, I suppose. But yeah, typically when you want to buy stock, you have to put up 100% of the money. Not the case with real estate. You can put far less down. Another advantage of real estate is diversification. If you do have a lot of money invested in stocks, bonds, mutual funds, you might want to consider investing in real estate. It does not move in the same direction. The pandemic was a great example, right? Pandemic happened, stocks started to crumble really, really quickly. Huge correction in the market, right? Real estate, opposite direction. Real estate is considered a safe haven for money. It offers real substantive value. It's concrete. You can touch it, right? It exists, it occupies space, and for most people, it's not a discretionary purchase. For most people, they need a place to live, right? So it offers a level of security that a lot of other investment strategies do not. People always talk about like, well, during recessions, how does real estate perform? Historically, extremely well. It is a safer asset. Now, historically, there's going to be one exception, and that's the obvious exception, which is the year I got into the market, the year I got into business, 2008, right? Well, the one difference there is it was not, hey, the recession caused values to decrease. No. It was the exact opposite direction. Real estate is what caused the recession to occur. Real estate was the virus that caused the recession to occur. Very different, right? But most recessions, real estate actually performs very well. It's a safe haven for money. So yeah, if you need diversification, real estate might be for you. Another advantage is tax advantages, okay? So this is a screen grab of one of my earlier years of tax returns. And how it works with real estate is you are going to fill out a Schedule E. Schedule E is an Edward, okay? So what you're going to do is you're going to claim your rents at the very beginning. You can tell it's old by how much rental income I received. So you're going to have your rents at the very top. Then you're going to have all of your deductions on this property. So, hey, great, there was $2,739 in cleaning and maintenance, $216 for HOA insurance, management fees, mortgage interest, taxes. And one of the big advantages of investing in real estate is depreciation. This figure right down here. It's important for a couple of reasons, okay? So what is depreciation? Depreciation is Uncle Sam, okay, the IRS saying like, look, over time, properties will erode. Over time, properties will erode, they will fall apart. If you do absolutely nothing to your property, over the course of about 27.5 years, very specific, your property will erode into nothing, okay? It's why we maintain our properties, because if we did nothing, it wouldn't take very long for it to go to basically fall into disrepair and basically be worth nothing, okay? So what Uncle Sam says is, you can take the value of the structure, not the land. The land does not depreciate in value, okay? The value of the structure, divided by 27.5. And you can take that as an annual depreciation figure for as long as you own that rental property. You could also take it one time at the very end, however many years you own the property, that much of that depreciation. Which one is going to be better for you? Ask a CPA, okay? For your first year when you own a rental property, you're probably going to want to get a CPA. Even if you don't historically have one, I'd recommend getting one your first year. They're going to need to help you walk through some of this. TurboTax will try, and that might be sufficient, but you really need to know, like, when do you take your depreciation? But the thing about depreciation is it's kind of abstract, right? It doesn't really exist tangibly. You can't really point to it and say, hey, there's the depreciation. No, you're constantly maintaining your property, so you don't really see it, hopefully. Well, if I didn't have this deduction, this number right here would actually be positive. And that would mean I would have positive rental income and therefore have to pay taxes on that income. But since I get to throw in that depreciation, it brings this number from a positive down to a negative, and it reduces my taxable income. That's one of the big advantages of rental properties, is the tax benefit of it. Even though interest may not be deductible for you on most properties, with a rental property, it's always going to show up as an expense. And so long as it shows up as an expense, it's very likely that you're going to have a negative number when it comes to doing your taxes. That's good. It's going to reduce your tax liability. Okay. Again, which is best for you? Taking it one time each year, or taking it when you go to sell a property as a one lump sum? Ask your CPA. Okay. What's your tax bracket currently? What's your tax bracket can be? They're going to look at all that for you. For me, my rental property strategy was, I'm caring far less about appreciation because I'm simply never planning on selling the properties. That's my hope. That's my hope. My hope is that I can get the loans paid off in full. I can cash flow 100% minus taxes, insurance, and HOA dues. And then I never have to really worry about it. Okay. So depreciation now or later for me was a very straightforward decision because I'm not planning on selling the properties. There is no later for me. There's only now. Okay. Another advantage with regards to taxes is what they call a 1031 exchange. So 1031 exchange. Okay. Typically, if you were to go sell an investment property, you're going to have to pay capital gains on that appreciation. What you buy the property for, what you sell the property for, you have to pay capital gains on that difference. 1031 exchange is a way of delaying paying those capital gains. So here's how it works. Okay. Number one, you're going to have to identify a qualified intermediary. Okay. Qualified intermediary. It is a 1031 exchange company. Okay. How do you find a 1031 exchange company? Typically, you'll talk to your title company. Okay. In Colorado, we use title companies. We don't usually use real estate attorneys unless something's gone horribly wrong. Usually we use title companies, right? Every title company has 1031 exchange companies they work with. So you'll ask your real estate agent, hey, who do you use for a title company? Can I get the name of your closer? Great. Here's the name of the closer at the title company. You call them, hey, who do you guys use for a 1031 exchange company? That is the qualified intermediary. And they will charge you a small fee for this. Typically ranges in, $500 to $1,000 somewhere in there historically. So you'll identify your 1031 exchange company. You will list your rental property to sell. And then once it sells, your proceeds from that sale will go to that 1031 exchange company. The proceeds from that sale never go to you. Critically important. So the second they go to you, 1031 exchange does not happen. Okay. They have to go to the 1031 exchange company. Okay. So you'll sell your house, funds will go to the qualified intermediary, 1031 exchange company. Now, the second you close on your sale, timing matters a lot. Okay. You've got 45 days to identify a replacement property. So this only works if you're buying another investment property. And then you've got 180 days from when you sell your property to close on that new purchase. So 45 days to identify, 180 days, 6 months to close on that new house. The 1031 exchange company will then transfer the funds from your original sale to that new purchase. The idea behind a 1031 exchange company or a 1031 exchange is to bring your rentals into a medium type of property that's going to suit you better. Maybe it suits you better for your life stage. Maybe it simply brings them closer to you. I've got a lot of people that will want to retire in Colorado, right? But their investment properties are scattered all over the country. Well, we lived in New York, so we bought one property there. We moved into Florida, bought a property there, moved to California. So we've got 3 properties in 3 different parts of the country. Well, great. A 1031 exchange, you could sell those properties, buy new properties near you so that you can keep track of them, monitor them better, right? Hopefully, maybe avoid a property management company, maybe manage the costs a little bit better yourself, bring them closer to you so you can better manage those properties. Very, very common route to go. Or maybe you were doing, condos and townhomes and you'd rather do a single family home. Something like that. Or maybe you had long-term rentals and you want to go to short-term rentals. You want to buy a house up in Beaver Creek or Vale and you want to go the short-term rental route. Maybe that's the case. So it basically restructuring your portfolio of real estate in a way that's a little bit more easier to manage for you. Maybe it suits your financial picture better. Maybe it suits your location better, whatever the case may be. Okay, that's the idea behind 1031 exchange. You sell rental properties, you then roll those proceeds over into new investment properties without having to pay capital gains right away. You'll still have to pay capital gains when you go to sell those replacement homes, but this is a way to kind of defer it. Now, with regards to a 1031 exchange, it's what they call a like-kind exchange, which means the property has to be of like kind. That's tricky, okay? The IRS has given some very specific guidance and some not so specific guidance, okay? It has to be investment property to investment property. You cannot sell a primary residence and go buy an investment. You cannot sell an investment and go buy a primary residence. Like kind means investment to investment, okay? Vacant land never qualifies. Vacant land to a structure that they don't consider that investment, okay? However, the number of properties can change. You could sell 1 property, go buy 3. You could sell 3 properties, go buy 1. Perfectly fine. They still consider that all like kind. You can go from condo to single family to condo. That's perfectly fine too. So investment to property to investment property, they do not allow for property primary residence. They do not allow for land. None of that's considered like kind. But it is a nice way to defer paying capital gains. People usually get questions on that. If you got questions, drop them into the chat to Allison. She'll aggregate them for us. So let's talk about some of the disadvantages. I'm not simply going to blow smoke up your skirt and tell you that there's no disadvantages. There's plenty. Liquidity. Liquidity is a problem, right? When it comes to real estate, you can't just click a couple buttons and get access to the money, right? If you need to tap into the equity that you have in that house, you either have to sell that property, it's just expensive. Selling real estate takes a lot of money, right? Closing costs. Or you could do like a cash out refinance, which also has closing costs, and also you have to deal with the rate, what are rates at today. Those are really the only two real ways to access the equity in your house. You could also go get a home equity line of credit, I suppose, but it's not a really liquid asset, right? It's not meant to be. It takes time, it takes money to sell that asset. Other disadvantages, high transactional costs, right? This is in the news a lot right now with the National Association of Realtors settling their lawsuit. But real estate has high transactional costs. Historically, sellers have paid about 6% in real estate commissions when they go to sell their house. Buyers, when you go to buy, you don't have to pay the real estate commission typically, but that all might be changing soon. So it has high transactional costs. It also has high maintenance costs. Water heater breaks and your furnace breaks, yeah, it could be out $5,000. So it's got high maintenance costs. And while real estate is highly leveraged, and we're going to be looking on the next slide about some loan numbers and looking at our first scenario, while it is highly leveraged, it still requires a significant upfront investment. If you're trying to do 20% down on an investment property, you're looking at a $250,000 home, yeah, you're still looking at $50,000, right? There's still a high upfront transactional costs. It's a big disadvantage of real estate. Stocks are very cheap to get into, right? You can go buy penny stocks. Not the case with real estate. All right, let's look at our first set of numbers to really put home my leverage emphasis, okay? So I looked at a property scenario. It was listed at 320. Loan amount would be 240 if we did 25% down. There's a financial advantage to doing 25% down instead of 20% down. The minimum for an investment property is 20%. The rates improve drastically if you can do 25% down. Most investors, when they look to do the numbers, they look to see if they can do 25% down to make the numbers work. So PITIA, what does that mean? Principal, interest, taxes, insurance, and association dues. Okay, so PITIA, the whole housing payment. Okay, came out to be $2,158.06. Your initial investment, including your 25% down, closing costs, prepaids, everything, is $87,900.07. So you knew I was not making up these numbers. They're too specific for me to make up. I assumed a couple things. I assumed 5% appreciation, which is fairly accurate long-term along the front range. 3 to 5% is very common. We had some really crazy years after the COVID-19. We were one of the nation leaders with regards to appreciation, but taking out those kind of unusual circumstances, around 5%, fair assumption. 25% down, 7.25% rate. I looked up the rent. People always ask me, like, how do I find out rental data? There's two things I really rely on. You could rely on Zillow. Craigslist is one of the two. Craigslist is still a really good resource for rental data. It's amazing. They haven't really improved upon Craigslist when it comes to rental information. So Craigslist is one good one. And then the other one, the second one, is Rentometer, rentometer.com. They'll let you look up a couple examples for free, and then after that, they want to start charging you. But rentometer.com, they try to do for value rental markets what Zillow does for values. The difference is Zillow is relying on public records data, and they have black and white information. Hey, this house sold for this much. It's all public records. Not so much on the rental site. So what they're going to do is they're going to give you a pretty wide range. Hey, it's, rent somewhere between this and this. So take it with a grain of salt, but it's still a good data point, if nothing else. Okay. And then I assume selling costs of 7%, 6% for real estate commissions. I took off 1% as well for tax prorations, closing costs, things like that. Okay. So I think these are pretty decent assumptions. I didn't want to skew the equation drastically one way or the other. So after 5 years, long time, you'll have collected $8,516 more in rent than you would have paid in mortgage payments. Your immediate response should be, whoop-de-doo, $8,500 over the course of 5 years, and I invested $87,000 to make it happen. What a ripoff. That should be your response. However, 5% appreciation each year. That means you'll have $181,633 in equity. minus your initial investment and selling costs, you'll have a net gain of $65,145. If I add $65,145 plus $88,516, we get $73,661.45 in net income, or a return of 83.8% over the course of 5 years. Okay. How is that possible? 16.7% return every year? That's crazy. That's crazy. Stocks historically average like 8%, right? Like how, and all of it is holy, do you get 16% return on your investment? In one word, leverage. You're putting 25% down, but you're getting 100% of the appreciation. And to really hammer that home, if you paid for that same house cash, you would have received $106,750 more rent than your expenses, taxes, insurance, HOHs at that point. Since there's no mortgage, you don't have to worry about your interest, right? That plus the appreciation minus the sales costs, you would have had a net gain of 51.1% versus 83 over 5 years, or 10.2% per year. Still very strong, but nowhere near as strong as if you had gotten the mortgage on that property. Again, financially savvy decision. Great, buy as many investment properties as I can, putting the least amount down that I can to buy even more. That's the financially savvy decision. The emotional decision is I'm just going to pay cash for the house. To heck with return on investment. I just want to keep my expenses low so I am not losing sleep at night. Fair enough, right? The two don't always go in lockstep with one another, and I can certainly wrap my head around both. Financially savvy decision, yeah, leverage. The emotional decision, paying cash, right? I have this conversation with folks all the time. Again, at the end of the day, ultimately, all I really want is what's best for you. And yeah, for some people, their amount of stress that they can handle or their amount of risk tolerance is very low, in which case, yeah, pay cash. Perfectly fine. You're still going to get a solid return on investment. So let's talk about the financing, okay? So like I said, 20% down is the minimum for an investment. If you put 25% down, the rates are going to improve. And they're going to improve pretty significantly. When I was running the numbers yesterday for somebody, putting an extra 5% down improved the rate by about 0.5%. That's a sizable move. For 5% down, 0.5% in rate, pretty drastic. Worth noting, when you bought your house as a primary residence, you could have gotten a gift from family members for that house. You cannot get a gift when it's an investment property. Okay, when it's an investment property, that money has to come from you. Do not hold physical cash either. Physical cash does not work. You can get around both of these issues by putting the money in your bank. Okay, once you go under contract on a property, we're going to ask for the most recent 2 months of asset statements. Okay, so if you go under contract right now, we're going to be asking for March and February's bank statements. Anything that happened prior to February, we are not privy to. We do not know about it. Okay, so keep that in the back of your mind. If you did want to receive a gift, if you were trying to buy a house with, maybe some friends that just want to contribute money, okay, great. Do that well in advance of going under contracts so that when you do go under contract, you can supply 2 months of clean asset statements, okay? Same thing with cash. If you got cash at home in a safe, deposit that money. We cannot use cash. Get it seasoned. Once the funds are in your account for 2 full months, they're considered seasoned. I no longer have to find out where those funds originated from, okay? Source of down payment, savings. Ultimately, you're going to want your money in a savings or checking account because you're going to have to wire the money to the title company for closing. And if they're currently in like a stock account or a mutual fund account, not a problem. You will have to liquidate those funds. You will have to sell those stocks, bonds, mutual funds, get them into a liquid account so that you can transfer it to title when the time comes. The government also does allow, so they do allow, for you to use a secured loan for the purpose of buying a house. Secured loan means it's a loan against an asset. Okay, a 401k is a secured asset. You can get a loan from your 401k provider against that loan, and you can use that money. Those are typically hard to do for investment properties. Your 401k provider is very lenient when it comes to a primary residence, not so much when it's an investment property. Home equity line of credit. If you already have a primary residence, you could take out another loan on that property and use that money to go buy another house. You could refinance your home, take cash out, use that money to go buy a house. All of those are perfectly fine. They're all secured loans, okay? So secured loans are perfectly fine. Unsecured loans are not. When it comes to qualifying for an investment property, investment properties are considered to have a higher risk of default. Again, all things being equal, times get tough. You're more likely to skip payments on your investment property than your primary residence, okay? Because of that, they're going to have higher interest rates. That effect is somewhat mitigated if you can do 25% down. They're also going to have what we call reserve requirements. Reserve requirements are funds left over after closing. If you buy a primary residence, you can bring every penny you have to closing. Shockingly, perfectly fine. Government's all right with that. Not the case when it's an investment property. Their concern is, well, what if you don't find a tenant right away? Okay. So plan on having leftover funds after closing called reserves. They can be in retirement accounts, perfectly fine. They could be in brokerage accounts, perfectly fine. You do not have to move that money over to the institution that's doing the loan for you. Okay. So yeah, where it's at, it's currently is perfectly fine. We just have to show that you do have assets available above and beyond your cash at closing. How much? We're gonna be talking about that in the next slide. We get to use, and this is one big advantage of qualifying for an investment property. When it's an investment property, we get to use 75% of the expected rental income to help us qualify for that mortgage. Now, why 75%? Well, kind of government logic here a little bit. They assume, kind of crazy along the front range, they assume your property is going to be vacant 25% of the year. Properties aren't vacant like that in Colorado, not where we live. My office is in Broomfield. It's just no way. We see vacancy rates in like, low single digits, not 25%. Doesn't really matter. Federal government, federal rules, that's what they're looking at. Okay. So they will use 75% of the expected rental income to help us qualify. So if rental income is going to be, $1,000 per month, we get to use $750 of that to offset the current payment we're saddling you with. So that's really nice. It means that I can qualify most investors. If they have the down payment, that's typically the biggest hurdle. Once we get past the down payment side, yeah, the cash flow, the debt to income ratio side is perfectly fine. Maybe there'll be a little bit of a difference between that 75% and what your mortgage payment is. However, it's going to be like saddling you with a new car loan instead of a new mortgage. Okay, I get to use 75% of that rental income to help us qualify. Now, Allison, question.
Yes. Have you seen larger corporations entering the Colorado market in ways that are putting the market at greater risk long term? Examples being BlackRock or other REITs.
Yeah, so real estate investment trust. That's what
Okay.
REITs is.
Gotcha.
Real estate investment trust. So the idea behind a real estate investment trust is it's a company that you could go buy stock in and then be able to take advantage of the real estate market because they are investing in the real estate market. So it's a way to kind of invest in real estate without you investing in real estate yourself, with kind of mitigating some of the risk as well. However, it's also going to be costs associated, right? Because they have their staff that they have to pay instead of you just worrying about paying possibly a management company, right? So definitely a different strategy, not one that we talk about so much here. As far as it being a big market disruption, you'll hear some news stories about it really impacting things and how large corporations are coming in and buying a lot of real estate. I personally have not seen that impact on the real estate market. My rentals, I've got a few of them scattered along the Front Range. I haven't had any issues with vacancy. I haven't had any competitive situations arise where, people are saying, well, we could also go over to this apartment complex or this structure over here and get cheaper rent. I really haven't seen it disrupting rentals too much. Anecdotally, there's supply and demand, right? Those companies will only come in as long as there's real estate to be gained and properties they take advantage of. We just really haven't seen a big impact. Also, the properties that most of those companies are investing in are different than the types of properties I personally invest in. My individual strategy, anecdotal, take it with a grain of salt. Everybody goes about it different ways. But my strategy has been townhomes. Townhomes, I like the low maintenance aspect of it. I like the large draw of people that it attracts. Townhomes attract young professionals, maybe those that have dropped out of school, maybe divorcees, maybe younger families. It tends to attract a large pool of people, and the turnover on those is very different. Well, BlackRock or whatever, they're not coming in and buying townhomes typically. They're looking at multifamily homes typically. They're looking at apartment complexes. They're looking at bigger structures. I just haven't noticed the impact on the smaller residential stage. You might if you're buying a condo in an apartment complex or something like that, but as a general rule, I haven't seen a huge impact of it. And again, supply and demand, it's always going to kind of equal on the end. They're only going to come in and buy properties when there's meat on the bones. And if there's no longer meat on the bones, they're not going to be doing it. They're in it for profit and purely profit. So great question. Not a great answer other than anecdotally, I haven't seen a huge impact on the rental market. Last thing I want to mention on this slide, covered that. Actually, no, we'll get back to it later. So yeah, that's fine. We will move on. Oh yeah, sorry. Can use 75% of the expected rents to help us qualify. How do they determine that rental? Well, when you do an appraisal on a rental property, okay, they're looking at what is the value of the property. They're also going to do a separate schedule. It's called a rent schedule. It's going to show how much they think that property will rent for. So that appraisal will actually come back to you when we get the appraisal report and say, hey, we think this property will rent for $2,000 per month. And they will let us know based on other properties they've seen in the area. They will call around, they will check Zillow, they'll check Craigslist, they'll drive around and look for rent signs and call those for rent signs and then plug in that data point. So they will let you know how much they think the rental amount is. I get to use 75% of that to help you with the mortgage payment you're getting. All right. So let's talk about the reserve requirements. Okay. So when you're buying property 1 through 4 finance properties, minimum down is 20%. Again, if you put 25% down, rates are better. Reserves are required. It's going to be 2% of the unpaid principal balance on your loan. On any investment properties you have, plus 6 months principal, interest, taxes, insurance, HOA dues on the subject property. Okay, I always feel like this is best to explore with an actual example. So let's say you have 2 rental properties already. You have a $150,000 loan balance on each, and you're buying a rental property with a housing payment of $1,500. I would take those $150,000 loan balances, multiply it by 2, okay, to come up with $300,000. I would multiply that by 2% to come up with $6,000. I would then need an additional $9,000 PITIA payment times 6. Okay, so 6,000, 9,000 gets me to total reserves of $15,000. Again, can be in a 401k, can be in a retirement account, can be in a brokerage account, all perfectly fine. I just have to show in this example that there's $15,000 left over after closing, in case you didn't find a tenant right away, something like that. Properties 5 and 6, still 20% down, yay. Reserves are now required at 4% of the unpaid principal balance, okay? Again, example, $150,000 loan balance is nice and easy. 4 of those, so $600,000. I now need 4%, so it's gonna go from $6,000 to $24,000, sorry. And then I still need 6 months PITIA, principal, interest, taxes, insurance, association dues on the subject property. So $33,000 total. More properties you get, the more expensive it's going to get. Properties 7 through 10. Now you need 25% down. Okay, now we need 25% down. If you weren't putting 25% down before, you're needing 25% down now. It's now 6% of the unpaid principal balance. More properties, more risk. If you own 8 properties, $150,000. Now all of a sudden I need $72,000 there, still $9,000 on the subject, $81,000 total. Okay, 7 to 10. So 10 finance properties is the max the government will allow if you're buying a second home or investment property. They do allow you to have more than 10 finance properties if the property you're buying is a primary residence. Okay, the property you're buying is a primary residence, they no longer have any limitations. So let's talk about different properties. So there's your detached single family home, okay, not attached to anything. You've got your townhomes, which are side by side, right? You might have a neighbor on one side or the other, maybe both, but you don't have anybody above or below you, right? That's a big definition difference between a townhome and a condo. Townhome, you own the land you're on. A condo, you do not, okay? Townhome, side by side. Condo, typically one above the other. When it's a condo, there are some additional requirements that have to be met. And this is what they call a warrantable or non-warrantable condo, okay? If it does not meet these requirements, it is a non-warrantable, W-A-R-R-A-N-T-A-B-L-E, warrantable, okay? Non-warrantable condo. Non-warrantable condos mean Fannie Mae and Freddie Mac want absolutely nothing to do with them, okay? They do not want to partake in this lending. They do not want to participate in this property. You're going to have to go get different type of financing. So warrantable versus non. We're going to have to go to the HOA and get a questionnaire completed and find out some answers. If there's any litigation in the complex, you cannot get conventional financing. Litigation, HOA is suing somebody or being sued. Okay, typically builder defects tends to be the biggest one. The HOA didn't like something, so now they're suing the builder. They're now a party to a lawsuit. They are now in litigation. The HOA is in litigation. You cannot get conventional financing. Okay. Slip and falls, that occurs occasionally too. Somebody slipped and fell and now they're suing the HOA because the HOA is in charge of maintaining the sidewalks, right? It also cannot be a condotel. Okay, condotel, we see those occasionally up in ski towns, Beaver Creek, Winter Park, all that stuff. They have some features of a condo, some features of a hotel. They might have like a concierge desk or a short-term rental desk, something like that. They have house cleaning on site. They also have short-term rental desks. You can literally walk up and like rent the property out by the night. That's a clear-cut indicator of a condotel. Okay. So it can't be in any litigation or be a condotel. 15, the complex cannot have 15% or more of the units be delinquent on HOA dues by 60 days or more. If there are, it's going to be non-warrantable. You cannot get conventional financing. 20, complex cannot have one owner who owns more than 20% of the units. They're worried that one owner is going to fall in financial hardship and then just flood the market with a whole bunch of real estate at the same time. It's going to drop your value and affect your ability to sell that home if you needed to. 35, complex cannot have 35% or more of the square footage be commercial in nature. Okay. That one's pretty obvious when you drive up. You're like, oh, the bottom half is commercial, top half is residential. Yeah, clear cut sign it's going to be above that 35% threshold. And then finally, sometimes 50, when the purchaser of the unit is an investor, so assuming everybody here, and less than 25% is being put down, at least 50% of the units must be owner occupied. That is a constant issue along the Front Range. It used to be, didn't matter how much you were putting down, this was always a question that was asked, and then it was a real big issue. Now that they changed it so that you can just put 25% down to avoid it, it's become less of an issue. Okay. Now, if it is a non-warrantable condo, you're going to have to get different financing, okay? It's going to take that 30-year fixed off the book, no longer an option. Now we're going to be looking at portfolio loans, which is going to fall more like commercial, okay? Insofar as less favorable loan terms. We're going to want to do like a 7-year fixed arm. We actually do a lot of non-warrantable condos at elevations. Us and one other lender in the area are like the top 2 lenders with non-warrantable condos. So keeping your eye out for that. If you are looking at condos, yeah, keep your wits about you. Maybe your agent knows, maybe the seller might already know if it's a non-warrantable condo. Okay. All right. Flipping the script. Let's talk about, you currently own your current house and you want to convert it into a rental. Okay. What are some things you need to look out for? Okay. What are some questions you need to ask yourself? I always start with this question. Would you buy it as a rental today? Okay. And now we're starting to enter Aaron's story time a little bit. Okay. So I had a property. I did the whole primary residence house hacking thing a couple times, acquired a few different properties that way. And then I was at a stage where I was like, I want to move on to my next house. But this property that I was currently occupying, not sure if it would be a good rental. And I had to look myself in the mirror and ask myself that question. Would it be a good rental? One of the questions I'd ask myself was, does it require a lot of maintenance? Well, the roof is getting older. The furnace was on its last leg. The air conditioning unit was also almost done for. So there was going to be some pretty big, significant expenses on the way. Also, it didn't fit my strategy. It didn't fit my original strategy. My strategy has been investing in townhomes. This one happened to be a single family detached. And again, it didn't fit my strategy. It was going to require a lot of work going forward. And when I asked myself the question, like, would I buy it as a rental today? The answer was simply no. The answer was no. I would have been better off, and I did, selling that property and going and buying a different investment property, okay? Just because you're selling a home doesn't mean you can't go invest in another, right? So I did exactly that. I also asked myself, how emotionally attached was I to the house? When you rent out a property, the tenants are going to live in it. Shocking, I know. But a great example is a rental car, right? Tesla used to have a lot of rental cars out there, and a lot of rent dealerships have come out and said, okay, we're no longer going to rent out Teslas. People drive them like crazy, and they don't know how to drive them either. Like, they drive way too fast. They break the car. It's not great. So a lot of Hertz and all those rental car places have come back and said, we're going to scale back on the number of Teslas we currently have. People drive rental cars fast. So when you have a tenant, they're going to live in your house a little harder than you did. Okay. So make sure that you can reasonably, emotionally separate yourself from that property. You need to go from seeing your house as a home to seeing your house as just a house. Okay. And that can be challenging for some people. If you are going to be that overbearing tenant who cannot let go of their emotional attachment to the house, you're going to make a terrible landlord. Okay. So you need to be very open and honest with yourself. Can I detach myself from this property emotionally? Yes or no? Okay. And then potential tax implications. So this was the last one that was really important when I went to look at whether or not I sold that house. Okay. So when you go to sell a primary residence, and at the time that house was a primary residence for me, the title company is going to ask you 3 questions. Okay. Number 1, did you live in the house 2 of the last 5 years? Did you live in the house 2 of the last 5 years? Yes, I did. Great. Second question, did you use the house as a business? They're not asking, did you work from that home during the pandemic like we all did, right? They're asking, did you convert your house into a daycare facility? Did you convert your house into an auto mechanic garage? Okay. No, I did not. No, I did not. Okay, great. You did not use the house as a business. Great. Number 3, have you sold any other primary residences in the last 5 years? So long as you can answer those questions in that way, yes, I have lived here 2 of the last 5. No, I have not sold any other primary residences. And no, I have not, did not use the house as a business. You get to protect the capital, the appreciation on that house, completely capital gains free. Okay. Up to $250,000 for a single individual, up to $500,000 for a married couple. That was the last thing that I did when I was looking at whether or not I convert that house into a rental. And when I did that math, I was like, yeah, no, I should just sell this house. Okay. So be open and honest. Would you buy it as a rental today? Does it require a lot of maintenance? How emotionally attached are you to the house? And what are the tax implications associated with converting this house into a rental? Okay. It might be great for you. It might not be. Make sure you're being open and honest with yourself. Now, when we are qualifying you to buy your first rental property, and you currently own your primary residence, we look at trying to qualify for that new house. Okay. It becomes a 2-part question. Number 1, do you have the down payment available on that new house without the proceeds from your current house? That's number 1 question. If the answer is no, great. You either need to take out a loan on your current house, tap into the equity, or sell your house. Okay. Second question we ask you is, can we qualify to carry both mortgage payments simultaneously? If you're trying to buy a new house and convert your current one into a rental, can I qualify you to carry both mortgage payments simultaneously? If the answer is no, I now have to add in rental income on the current house, the house you're going to be converting. We'll call it property A. Property A, currently living there, you're going to convert it into a rental. You're going to go buy property B and live in that one. Okay. Property A, to use rental income on property A, I would need to get a signed year-long lease. It has to be a year-long lease. Okay. No short-term rentals, unfortunately, in this situation. It has to be a long-term lease. That lease would have to go into effect within 45 days of your closing date on the new property. So let's say you went under contract, you're buying a new property June 1st. Okay. Property B, June 1st closing date. I would need a signed lease that goes into effect no later than July 15th. Okay. Within 45 days of closing on that new property. Okay. They want to make sure that lease isn't going to be like several months out. They want to make sure that's in a fairly short time period. So within 45 days closing, signed year-long lease, I can now use 75% of that rental income to offset the debt payment that you currently have on property A. Okay. So if you're like most mortals and you can't qualify to carry both properties simultaneously without having some additional income added in, great. Sign lease, goes into effect within 45 days of closing. Very easy, very straightforward. We do it all the time. It does add a little bit of a wrinkle. Once you go under contract on property B, you're going to have to start advertising your current place, property A, for rent. Advertising it online, finding suitable tenants. You're going to have to do all of that, get a signed lease by closing so that you can close on qualify for property B. Now, you need to make sure that you are keeping track of tenants, okay? And that you're evaluating them appropriately. When I was first getting into the business and I had my real estate license and I was doing a lot of property management, it wasn't just a tough environment for real estate sales. It was also a really tough environment for rentals. There was a lot of rentals available. There was a large amount of vacancy. And a lot of the tenants, they weren't in the best financial shape. They had been affected negatively by the housing crisis, right? So when you are evaluating tenants, do not skimp, okay? Make sure you're doing all the due diligence you possibly can, okay? You need to get a credit report pulled. There's a bunch of services online now that will help you along with some of this. There's websites that will actually assist you with double checking references, double checking a credit report, all of that, okay? So have a credit report pulled, review the credit report. For a mortgage qualification, we want to see ideally above a 680 credit score. There are government loan options available down to a 620. Knowing what I know, if somebody's below a 620, I would be very hesitant to have them be a tenant for me. Knowing what I know about credit reports, having been in this industry as long as I have, If somebody's below 620, it's not a good sign. They've got a lot of things on there, most likely very recent. Okay, I would be nervous of that anecdotally, personally. Required completion of a full rental application. Again, websites online that can help you along with this. Double check their references. Horror story from one of my first days of property management. Had 2 tenants available. Okay, tenant A, tenant B. Tenant A had good credit, not great credit, but good credit. They had 2 dogs, 2 bigger dogs. Okay, tenants B had terrible credit. Terrible credit. I was also not able to check any of the references. I called, the numbers were disconnected, red flags all over the place. Okay, but they did not have any dogs. I presented both tenant A, tenant B to my homeowner, and they got to choose who they wanted. My recommendation would have been first couple. Was able to check their references, decent credit score, but it was a brand new home. It was a brand new home, and the owner really did not want dogs. So he went with tenants B. Tenants B paid their security deposit and first month's rent in cash. Red flag. Red flag, red flag, red flag. If you do not have a checking account, that's a red flag. Okay. I was not able to check their references. Also red flag. But they didn't have any dogs. And that's true. They lived up to their end of the bargain there. They did not have dogs. However, they never paid 1 month of rent after that first month's rent security deposit. And when we went to the property 2 months later to check it out, they had burned holes into the carpet with cigarettes. They had punched holes in the wall. They had stolen the furnace. I joke you not. When you see a red flag and you are vetting tenants, you need to listen, okay? You need to listen. I learned the hard way. Unfortunately, my poor homeowners learned the hard way too. They got security deposit, first month's rent, and that's all the money they ever saw. If you cannot vet references, let them know. Make sure they get you a different number. Okay. If their credit score starts with a 4 or a 5, red flag. Okay. If they want to pay for their security deposit and rent in cash, red flag. Okay. You are not selling a couch at a garage sale. Okay. You are renting out your home. You need to be very careful. You need to listen to that gut instinct of yours. Okay. Protect your investment. So you need to be very clear with expectations up front. When I'm qualifying somebody for a mortgage, I'm asking about social security numbers and birthdays. A member misheard me the other day when we got to some of the government declaration questions. She thought I asked her what her weight was, and she told me what her weight was over the phone. Okay. I mentioned that because when you are vetting tenants, you can ask them darn near anything you want. There's some limitations. You need to be aware what those limitations are. Talk about that in a couple slides as well. But you can basically ask them what you want, and you can be very clear with your expectations up front. I'm going to inspect the property 4 times a year. If you set that expectation up front, they know exactly what they're getting themselves into. Key to happiness, I tell people all the time, low expectations, right? You need to manage expectations, okay? Inspect the property. If you're not doing it quarterly, which might be overkill, at least twice a year, okay? Spring, fall, whatever. Make sure you're inspecting the property and treat it like a service. Hey, want to come by the property, inspect the property, make sure everything's going all right for you, make sure that there's no repairs that are needed. Yeah, treat it like a service. I'm trying to see what repairs are needed. Meanwhile, what you're doing is making sure they're not damaging your home. Okay. If not quarterly, which might be overkill, I agree. At least twice a year. And if you can't do it, you need to find somebody that can. Talk about that on the next slide. Start with a solid lease. You can download a lease online, the Boulder model lease. That's what most landlords in Boulder, city of Boulder, use. It might be a little bit tenant friendly, but yeah, it's not a bad place to start. Use a professional for your taxes. I've already talked about that one time. I'm not a CPA. You really should get one your first year. Okay. Be responsive. Like most relationships, you get out what you put in, right? So if you are responsive to their requests, they will then treat your property a little nicer. Okay. And then know yourself. If you cannot do one of these things, you need to hire a property management company. Okay. That was the breaking point for me. When I started to realize, I started to skimp a little bit on my twice a year inspections of the property. I remember I got so busy with work and I was engaged and everything just kind of took a backseat. I stopped going to the property, and a year went by and I never looked at the property. I'm like, I'm no longer listening to myself. I need to hire a property management company that does this for a living. They will evaluate tenants on your behalf. They will get you a lease that they will have executed. They will give you options. They will say, hey, great, tenant option 1, here's the situation. Tenant option 2, here's the situation. Tenant option 3, here's the situation. Who do you want to go with? And you get to ultimately decide. It's ultimately your decision. Their job is to help you along the way. They will pull credit. They will vet references. They will do all of that. Okay. They will perform routine maintenance. That's one of the best things about it. You don't have to worry about your water heater breaking at midnight and getting a call from your tenants at 4 a.m. No, you've got a company for that. And now instead, what I do is I get an email from my company saying, hey, had a complaint about the furnace not working. We went out to the property. It was a pretty minor thing. We had a service company come out and service it. It was $150. You'll notice your rent check is $150 light this month. Great. Well worth it to me. Average cost of a property management company. So 50% of the first month's rent is very common, okay, to do all that vetting, showing, advertising, pictures, all of that. And then it's typically around 10% each month after that. If you do a short-term rental, it's going to be significantly more because they have to do significantly more work. Okay. Instead of having like one tenant in there every 12 months, they're going to have one tenant in there every, 5 days. So extremely more thorough, a lot more work that has to go into it as well. And the costs are going to be significantly more. It's very common for it to be like 40 to 60% of your rental income. Okay. If you are going tenant management yourself, and for me, I was able to manage a couple properties myself. And then once it became more than a couple, it became like a full part-time job. And I just had to hire a company to take care of it for me. Property management company works wonders that way. If you are going to go yourself, you need to be aware. It is your responsibility to know the state and local laws related to landlord and tenant relationship. Anti-discrimination laws. When I said you can ask them anything, there's limitations to that. You can't ask them anything. I take that back. Security deposit limits and return rules. How much you can have. You can't just set an arbitrary amount. There's limitations per state laws as to how much you can actually hold and how long until you have to return those funds. Requirement to provide habitable housing. If you had somebody that has a wheelchair and needs wheelchair access to the home, you can't just say, no, my house is not ADA compliant. It's your job to provide ADA compliant homes. There's some limitations as to how much it can cost you. They may have to foot the bill some of it. But you can't just flat out deny them because your house is not ADA accessible. Okay. Disclosure of lead-based paint or other hazards. If you had a house that tested positive for meth, you might have to disclose that. Lead-based paint, asbestos. Okay. So there are some things you need to be aware of. If you don't feel comfortable with this, I would say you need to hire a property management company. If you do want to go yourself and take care of this, a lot of real estate classes, they will spend a decent chunk of time on property management. So that is one way you could get your feet underneath from you with regards to learning all of this. Just because it's like most laws, right? Ignorance is not just make it all permissible, right? It's still your responsibility to know. So keep that in mind. All right. We're going to talk about some analysis here. We're going to go into the weeds a little bit on the numbers, okay? And this is really the last kind of thing we're doing, but it's going to take us a few slides, okay? My job here is to really instruct you, give you some guidance as to how do you calculate the benefits of one rental property versus another? How do you compare different rental properties? Okay. All right, so here's the first scenario, okay? So this is a townhome in Westminster. It was listed for $385. These are all real life examples. I pulled real life information, okay? I used 25% down, or in this case, $96,250. Here's the principal and interest, the mortgage part of your mortgage payment. Here's your property taxes and insurance, okay? And then HOA dues. It is a townhome, so you have HOA dues, okay? Total monthly cost, when we add all this stuff together, is $2,535. Your monthly rental income is $2,600. Got that from Rentometer. Now, this is one of the big takeaways here, okay? And I want to spend a second on it, okay? So net income. If you just subtracted $2,535 from $2,600, you would get $65 in net income. Doesn't make the numbers look very good, right? And admittedly, right now with rates where they are, it's hard to make the numbers work, okay? That's just the truth of the matter. When rates are low, it's easier to make the numbers work, okay? But one thing I'm always very cautious about is I want to figure out how much of my principal and interest payment is actually going towards paying down my loan. I think that is a more accurate representation of what your cash flow is. My wife, love her so much. She's great. She's my favorite person. She's wonderful. She's teaches English language learners up in St. Fran's School District. So math is not her forte. But she looked at our bank statements one time. She's like, why do we have all these rental properties? When you look at the the in-go and the out-go, they're like almost identical. I'm like, you're not wrong. However, my mortgages were on 15-year mortgages. And the amount that I was contributing towards principal each month was significant. It was almost 50% of that payment. Okay. And I was like, well, got to keep in mind, half this money is going towards paying down our loan. Half this money is going towards a very long-term certificate of deposit. We don't see it right yet. We will see it though later. Okay. They are actively paying down our loan for us. So I always make sure that I calculate how much of the principal and interest is going towards principal, and I make sure that I factor that into my net income as well. Okay. They're paying down your loan for you. In my eyes, from my perspective, that's numbers you need to take into consideration. 15-year mortgage payment might have a significantly higher payment, but more of it's going towards principal, also at a lower rate, right? So keep that in mind. In my opinion, the cash flow really should be 335 here because I'm taking into consideration the principal as well. Most people, they simply say in-go and out-go is $65. Now, worth noting that there's no vacancy factor here or maintenance accounted for, so you need to plan on that. But in this scenario, 5% appreciation, 7% selling costs, you would have made over the course of 5 years, 15.84% each year. Okay. Leverage makes all this work. Now, in this situation, you're primarily buying for appreciation, not cash flow. Unless you like $335 per month and you're looking at it that way. Okay. I then compared this to a single family home. More expensive, single family home in Longmont. Okay. Apples and oranges. Townhome in Westminster, single family home in Longmont. $459 sales price, $114,750 was your down payment. PITIA, $2,733. There was small HOA dues of $70 in this case. Okay. And your monthly rent was $2,750. So again, what's the net income? Well, $17, unless you're also factoring in your principal, and then it's really $339. Okay. I really think that's an important piece of this puzzle. Yeah, we can disagree there, but anyways, again, assumes no vacancy or maintenance costs. Well, guess what? The maintenance costs are going to be higher on a single family home than they are on a townhome, right? You need to factor that in. Again, though, in this scenario, it would have been 23.82% appreciation or return on investment each year when you go to sell a property. Again, another scenario, we were buying primarily for appreciation, less so for cash flow. So how do you compare these two very different properties? Single family home at $459 versus a townhome at $385 in Westminster. How do you compare these very different properties? Well, there's a couple different calculations you can run. I recommend running both of them. Okay. And there are flaws with both, which we'll talk about at the very last slide. So let's talk about cap rate. So the cap rate, it allows you to compare the net return on different investments based on the purchase price. I used my principal included rate as well. Okay. So we look at your monthly cash flow, in this case, taking into account the principal payment as well. You multiply that by 12, you divide it by the sales price, and you come up with your cap rate. In this case, the higher number is better. So if you looked at this, you'd be comparing the townhome in Westminster, and the bottom number is your single family home in Longmont. Yeah, according to this, the townhome is better. You're getting more cash flow for the sales price. Okay, makes sense. That's one calculation, cap rate. The second calculation is what they call gross rent multiplier. Gross rent multiplier. You simply take your monthly rent, multiply it by 12, divide the sales price by that. Okay, in this case, you want the lower number. Lower number is going to be better. But once again, that townhome in Westminster comes out ahead in this example. Okay, it's got the lower gross rent multiplier. Okay, rental times 12, sales price divided by that figure. In this case, again, it was rent monthly cash flow times 12 divided by your purchase price. All right, now a couple issues with both these calculations. Okay, run them both. There's no reason not to. Okay, but keep in mind some pretty important pieces. Neither calculation takes into account appreciation. Yeah, they are simply focusing on the cash flow or the rental amount. Neither one takes into account appreciation. Guess what? Single family homes appreciate more than townhomes or condos do. Okay, so I'm glad the townhome comes out ahead in both calculations, but single family home might come out ahead on the appreciation front. In fact, most likely would, in which case you might be better off going that route instead. Take it with a grain of salt. Neither calculation is perfect. Neither calculation takes into account a vacancy factor. Single family homes, in my experience, tend to have a little bit of a higher vacancy factor. Why is that the case? People that rent single family homes tend to do so with the intent of buying their own property in the near future. People that rent smaller homes, condos, townhomes, they might be planning on staying put for a longer period of time. Okay. Cap rate may make the figures look deceivingly bad if you're opting to do a short-term mortgage, right? because all you're doing is looking at your monthly cash flow. And if you're only looking at the net income, which is like quite literally in-go and out-go, yeah, it's going to negatively impact the numbers, which is why I factor in the principal payment. Okay. I think that's really important. I think it makes the cap rate work a little bit better because then it would take into account how much are you contributing towards principal each month. Okay. And then gross rent multiplier does not take into account maintenance costs. In our example, single family home, it's going to have significantly higher maintenance costs than a townhome, where the HOA takes care of the outside. Okay. So all things to consider, run both calculations, no reason not to, but take them both with a grain of salt. They are both flawed in various different ways. Okay. Helps you kind of get your legs underneath you and start to figure out, is there anything like completely out of the ordinary that doesn't quite fit my goals or my objectives? Yeah, great. Both calculations will give you that indication. But don't hang your hat too hard on either number. All right. That is it. I hope you feel a little bit more comfortable with investment properties. If you do have questions, all my contact information is here. Jot down my cell phone or my work number. Text me, call me anytime. Allison, do we have any questions that have popped up on your end?
I don't have any at this time.
We got a few minutes to spare, so we'll hang tight for just a couple minutes to see if anybody does ask any questions. Only got the one question. It's honestly, I love questions. It's a little disappointing. My heart's a little bit broken. Anybody questions? Anybody? People are just dropping off left and right.
That's all right.
It is indeed. All right. Well, thank you all for taking the time. If you have any other questions, let us know. Okay. Appreciate you all.